Welcome to the Gold Newsletter Podcast, your bank of knowledge of investments, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives to increase your wealth monetarily and educationally.
This is Fergus Hodgson with the Gold Newsletter Podcast, and we're at Francisco Marroquin University in Guatemala City, and I have here Dickson Buchanan, who's doing a tour to some degree of Guatemala. He's attending an event here and speaking on various days. He is the Relationship Manager for Monetary Metals, formerly of Schiff Gold, and he also holds a Master of Economics?
Master in Austrian Economics is the formal title, yeah.
Okay, so a Master of Austrian Economics from King Juan Carlos University in Spain. And I've been somewhat of, a digital acquaintance for a long time. He's now here in person. And I said, yeah, when you're here, let's sit down for a chat. And one of his presentations caught my attention, 3 lessons, or he's going to clarify the title, but 3 lessons from a DIY investor. So do you want to clarify, what is the title of your speech or your presentation you're going to give, and how you came to just 3 lessons of all the pieces of wisdom one can have in finance?
Yeah, and I appreciate you having me on the podcast. So the talk I'm going to give is titled The 3 Most Important Lessons I've Learned as a DIY, which is just an acronym for Do-It-Yourself Investor. And, you know, what I'm trying to do here is I kind of come from the school, and there's actually a great book called, what's the name? It's How I Lost $1 Million in the Market or something like that. Have you read that one?
No, I have not read it.
Okay, well, it's a bit odd, right? You'd expect to see the opposite title, How I Made $1 Million. But anyway, what I'm trying to do is consolidate the reality that, you know, there are a million ways to make money in financial markets, and there's actually only a few ways to lose money. I'm trying to distill down what are the foundational components of the basic building blocks that everyone should have in place for when they approach financial markets so that they limit their downside. So it's not about specific strategies for how to make the money. It's more about what's a sound long-term approach to markets that's going to minimize my downside.
Yeah, but you've mentioned DIY investor, so that suggests that already your strategy is not to rely on management of funds, so that you're going to take care of it yourself. Is that just because you want to have lower fees associated with your investments, or just because you have maybe a skepticism towards conventional brokers or money managers? That's
a great question. I think there's it could be a lot of different things. There's also one thing you didn't mention is arrogance. I just think that I can do it better than most people would be at least part of the reason. If you're an investor in financial markets, there's no way to get out of fees. I mean, even if you can lower your fees, but you're always going to have to pay a fee somewhere to somebody. So do it yourself is, I would say, it's twofold. In a sense, I am skepticism of at least call it mainstream financial management or wealth management, asset management. I think in the wake of the 2008 financial crisis, we saw portfolios get cut in half, and most of those financial professionals were, what were they doing to protect clients' wealth? What were they aware of the potential problems in markets? Were they aware of, the danger to client portfolios? So it's that. It's also the fact that I just, for as long as I can remember, I've been passionate about markets in general, and certainly attracted to financial markets, how they function. So it's in some ways it's a passion project for me. I like investing. I like the idea of allocating capital and allocating capital well is just is attractive to me in general. So it's, I guess, a combination of all those different things.
You mentioned 3 items or 3 lessons, or the 3 most important lessons. Why don't we put those on the table so then we can pick them apart or analyze them, because right now you mentioned them briefly, but I don't really know what they mean, and I'm going to have a hard time kind of quizzing you on them until you explain them.
Sure, yeah. So the three items that I'm going to talk about are the importance of planning, the importance of process, and I would say, just to unpack that one a little bit, the importance of having a defined and clear process for decision making, and then thirdly, the importance of patience. So that's they all start with P. I like what is it? I'm forgetting the word.
You like the acronyms, the abbreviations.
The acronyms, but also they all start with P. What is that?
It's an alliteration. Yeah.
Thank you. That's exactly right. Yeah, I just blanked on what that was. So planning, process, and patience. And again, these are, it almost sounds childish or not childish, but it almost sounds so basic. Is it even worth saying that? It seems like it would be so obvious, but at the end of the day, you'd be surprised how many actors engage with these markets without having any of those things really developed at the point of buying or selling, and so at the point of making decisions. So anyway, my journey has taught me the importance of having those things very well defined. So that's what I wanted to share.
And I don't think it's too simple or too childish to focus on those three elements. My sense is that the vast majority of people, for better and for worse, engage almost arbitrarily in their investment decisions. And there's a field within economics known as behavioral economics, which assesses maybe human irrationality or in the instincts that humans have that guide our decision making. So one example which we have reviewed in a class I've taken is the way that humans have more confidence than they deserve, perhaps. And so, for example, if you ask people whether they are better than average drivers, well, 80% of people think that they're better than average drivers, but of course only 50% of people can have. This is a common theme, that people have more confidence than they merit, and they think they can just outdo the market, which of course they cannot, not on average. So I do think that's why I like the idea, planning, process, and then patience, because that can maybe, in my mind, when I hear those terms, I think you're trying to mitigate human irrationality. That
is precisely correct. You said it very well. I think, there's so many things you cannot control when you're putting capital at risk. So what is your job then? Your job is to the best of your ability, manage and control the variables that you do have influence over, so that you can have an airtight process that's robust against, all the uncertainty that's embedded in markets, and the risk that you can't always see perfectly beforehand.
And what role has this study or your studies of Austrian economics, what role has that had in the formation of your thinking on investment?
That is a tough question to answer. I would say, my understanding of economics and markets in general is so saturated with an Austrian approach. So whether it's, viewing the individual economic actor as the decision maker and ultimate, he's not a robot, he's not a variable in a math equation, he's dynamic. Knowledge compounds. You have markets as a process of trial and error. They're not this, kind of given state of things or equilibrium. There's no such thing as equilibrium. Things are constantly in flux. It's I would say it's embedded in almost everything that I'm doing. The only thing I would say from a strictly financial markets or investment approach is just I would highlight capital theory. So that, this is an area where I think in some ways Austrians are weak, but in other ways are strong in terms of viewing human beings as capital allocators. We're all at the end of the day owners of certain capital inputs, and part of our job, and not 9-to-5 job, but part of our job as human beings to live well is to allocate those capital inputs well so that they generate more for us over time. They're outputting more than what we're inputting. So capital formation, capital theory, I'm very deep into monetary theory as well, particularly in today's landscape, financial landscape, where you have central banks having a larger influence on financial markets and market coordination. I think understanding monetary policy is really important.
I'm actually preparing for the CFA Level 1 exam, and I looked at, or I've been reviewing the updates to the curriculum, because the CFA is always an ongoing reevaluation of its curriculum. And they noted that the living in a low-interest world, that during the 2008 financial crisis, central banks around the world lowered interest rates very low, historically to almost unprecedented levels. We can say that. And at the time, people thought that those rates were just a temporary approach, but it seems like they're going to be with us for as long as we can see. I don't know when they're going to change. And so the CFA is actually exploring or covering how financial analysts should respond to a low interest and even negative interest rate, and negative real interest rate world. So it is a predicament. Now, of the 3 points you made, planning, process, and patience, I get the sense that patience is maybe the more of a virtue and less of a technical matter. So let's try and clarify the patience, and then we can go to the other two, where I suspect you can maybe break them down and actually give tools for people to work with.
Yeah, so on the third point of patience, there was I've got to give credit where credit is due. One of my favorite podcasts is a podcast called the Investor Field Guide podcast with Patrick O'Shaughnessy, and I have just absolutely devoured that. I can't believe it's free content. I mean, the content is so good. But I've devoured that podcast, and there was one episode where he had a guest on called Ian Castle, who runs a kind of a platform for microcap investors. So he specializes in microcap stocks. And he, you know when you hear something and it just hits you like a brick. It's like so true. It just changes, changes your perspective. And it was in that podcast or in that episode where he said, everyone tells you should be patient in financial markets. It's like kind of like telling someone they should be good, But what does that mean to be good? Well, he broke it down as patience is the only way to exercise patience in financial markets is you got to know your position better than anyone else. So really what patience boils down to me, is there's no replacement for knowledge. People like to compare financial markets to like a poker game, where, there's the common saying, if you don't know who the sucker is at the table, it's probably you. To me, this dynamic of the only way to be patient in financial markets is to really know your companies, it's to know your position, it's to know your strategy, it's to be so comfortable where you are so that all the noise, all the, the information that's going across your screen, all the time, if you know your position well, you have the ability or the capacity to actually sit on your hands and make better decisions than otherwise, right? If you don't know your position, if you don't know what it is you're actually invested in, you're a weak hand. You're either more likely to buy, you're more likely to sell, you're more likely to make decisions on a whim, and a lot of the reason for that is you don't have a strong enough conviction for why you own what you own.
Right, so one of the key reasons to have patience is basically that you need that to get over the hump of all the due diligence, to do the actual research. If you're just eager to just drop your cash wherever, well, I mean, that's the opposite of being a thoughtful investor. And yeah, as you said, patience is seemingly a trait recommended widely, but not necessarily listened to. One of the key reasons why I think patience is particularly important to emphasize is that starting off your investment or your saving at a younger age in life is so pivotal to your long-term returns. And if you actually look at the numbers, it's painful to think of all the people who delay it. And I look at myself to some degree in that regard as well, because obviously when we're young we want to go and enjoy our lives, and there's nothing wrong with that. But meanwhile, the nerd accountant is just racking up the interest, and the interest upon interest, which is the miracle which we're all aware of now. Okay, so I want people to have some takeaways. So with the planning and process, let's take this one at a time. With the planning, do you actually recommend any websites or software or particular strategies for how to plan for the individual investor?
That's a great question. The reality is that's a space I'd like to explore more. Most of what I've done has been kind of taking from a lot of different sources and kind of building my own internal system for how I do this. A lot of the sources that I've kind of taken cues from or pointers from really haven't been investment oriented. Maybe they've been more business oriented or entrepreneurship oriented. The same underlying principles apply, but I'm sure there's websites out there that would help individual investors do this. And gosh, if I'd have known about them, I probably would have contracted their services. But most of what I've done has been kind of a piecing together from a lot of different, schools of thought in a lot of different areas.
I don't know whether you have a certain routine you follow, or maybe a flow chart as to how you make decisions. Do you actually write these down to help you to keep yourself disciplined?
Absolutely. So that's something that I will highlight in tomorrow's talk. Is I am a big believer in writing everything down, documenting everything. I think now it's common. It should be common. There's all these research studies that say, you think better when you write. Something happens in your brain where if you start to write something down, again, I don't know the science behind it. All I know is that the results say that your brain essentially works harder and you get better clarity of your ideas. I mean, if that's true, assuming that's true, why would you not write it down? It would be it's like you're doing yourself a disservice. You're already starting with a handicap. I mean, that's a clear advantage you can use in your favor to write something down. Not to mention all the other benefits you get from that by having a documented reference that you can go back to, and you can say, well, here's what went wrong. What can I do to change it? A lot of this really is like applying the scientific method to investing, right? You have a testable thesis or hypothesis, your plan. You have a plan to make money in the market. You need a process to test that. You need a feedback loop to know what to change, how to change it. So these are the things that I try and focus on. And absolutely, writing things down, having it all documented. I'm a big believer in keeping an investment journal or a trading journal.
Is that just a digital platform, or you actually physically write it down?
I do everything digitally. I write everything down digitally in kind of a file system, and that includes like a trading journal. So yeah, I do everything digitally. I'm sure. I know people that do do things. What is it? Analog? Is that right? Is that the correct term? With a pen and paper. In print. Yeah, in print. Yeah. So, but regardless of what your medium is, what's important is that you actually sit down and do it.
Do you have a particular platform, or you just use generic Excel or Google Sheet files? Is there a particular tailored platform that you enjoy for this trading journal?
I like Google Drive. I do almost everything exclusively, or I should say I almost do everything. Everything I do, I almost exclusively use Google Drive for. I've kind of signed my life over to Google. I hope they don't do anything bad with all my information, but such are the times we live in. I like Google Drive. I also use Evernote as well. To answer your earlier question, perhaps in more detail, and when it comes to process, what we're really talking about, at least in investment, is what needs to happen for us to make a decision. So it's the process by which we arrive at a yes or a no to any given decision. And the most simple, something you could apply tomorrow, like if you wanted to put into practice this tomorrow, would be just coming up with a checklist, a simple kind of systems-based checklist of what are the 10 things that I want to make sure are in place before I make a decision. And then you log that, and then I'm a big believer, too, in building in times of reflection and evaluation. So what that might look like is once I complete a checklist or complete kind of a decision-making process, I'll schedule a time to revisit that and kind of look back at, okay, what was in place, what wasn't in place, how did it turn out, so on and so forth.
I use Toodaloo, which is a wonderful list and task managing service, and it's free actually. You can get a paid version which you can share with if you have an assistant or something like that. But what is Evernote? Evernote,
gosh, I think the official tagline is an extension of your brain or something. It's literally like a it's a lot of different things, but that's probably the best way to describe it is literally a digital extension of your brain. So text notes, pictures, powerful searching capabilities, so you can like build a file based on some theme, call it quotes, really good quotes. I just want to keep track of really good quotes, and I want to be able to access those quotes because I know I'm not going to be able to remember them all, so I'm going to store them all in Evernote. You can search back through those, doing like normal keyword search inquiries, and it'll be able to pull all that stuff up for you. So I don't use it, I don't use it to its fullest extent. I know there's features that I'm not currently availing myself of, but to the extent I have used it, I found it to be very helpful.
And in your own life, I'm not sure what impulses or instincts you have that you need to curtail or restrain, or maybe you want to emphasize some impulses, I'm not sure. But do you want to give some examples of how these 3 Ps have actually impacted your own decision-making?
Gosh, yeah, another great question. I mean, the reality is, Fergus, I'm a human being like everyone else. I make decisions impulsively. In fact, if anything, I think why I want to give this talk and why I want to highlight these things is that I'm probably more on the reactionary side of things. I grew up playing sports, and in sports, there's not a lot of thinking once you're in the game. It's mostly all action and reaction. But that isn't always the best way to live the rest of life. You want to think before you act. So I found these to be really helpful just in my own development. But yeah, gosh, I mean, making impulsive decisions has got to be at the top of that list. I feel like the default position for me is to make a decision and then try and figure out why I made it. I'd like it to be the other way around. So these are just tools that I'm becoming more familiar with that have been very helpful to me. I mean, to give you a practical example, I do a number of different things. I recently have started trading more in commodities and Forex on a shorter term basis. And I've been doing that for about 2 to 3 years, and I've seen significant improvements in my kind of year-over-year performance with greater implementation of these kind of making process-oriented decisions. So I've applied a very rigorous checklist that all these things have to, all these boxes have to be ticked before I make any market decision. To the extent that I keep that checklist, making a checklist doesn't guarantee. There's no substitute for actually being disciplined and self-control and actually doing the checklist. But to the extent that I can actually, complete that checklist, I found, my actual performance has been improved dramatically. So that would be just kind of a real world.
Yeah, at the end of the day, it's just like a constitution for a country. It's not a self-enforcing document. You are the final arbiter, so you can come up with all sorts of rationalizations to overrule what you've written down for yourself. It's not a magic bullet in that regard.
Do you want to rub elbows with the best minds in the precious metals and mining industry? You can on the Money, Metals, and Mining Cruise from May 28th to June 7th, 2018. Explore the jewels of the Mediterranean while discovering the latest strategies to successfully invest in precious metals and mining stocks. It's a perfect blend of adventure, learning, and luxurious leisure aboard the Crystal Serenity, always a popular destination. Cabins will sell out fast. Call cruise experts at 800-797-9519 to learn more, or visit our website goldnewsletter.com/cruise.
In terms of you expanding your own portfolio within this process, do you want to recommend any particular platforms or websites that you have come across that have helped you in that quest?
I don't. I'm pretty basic. I have an online brokerage account. I'm not necessarily married or in love with any particular one platform. I think investors need to kind of do their own due diligence in seeking out who they want to be their partners on the other side of the trade and who they want to use. It's funny you mentioned the word expand your portfolio. I would hope my portfolio expands in total capital, total assets, or at least total asset value. I'm actually a big believer in, or I should say a big proponent of having a non-diversified portfolio. I think there's a great quote by Buffett where he says, diversification is how we hedge against our ignorance. And if you know what you're doing, there's no need to diversify. And I think there's another one, Peter Bernstein, he says, diversification is the rational deployment of our ignorance. Well, you can diversify so much that you don't own anything. I mean, that's the other side of that coin, right? So I'm a big believer in having super focused portfolios and being very, very, again, going back to you can't replace knowledge, and you have to have knowledge to be patient, really knowing what you're investing in and almost being, a quasi-expert in what you're investing in, just having super focused and clear singular objectives with what you're trying to do.
It is contrarian to what we've had on before. We actually had a professor, his name escapes me right now, but a specialist in alternative investments, and he was trying to he was promoting modern portfolio theory, which is basically that you invest in everything. And so the exact opposite of what you're just saying right there. But before we finish up, I want to give you a chance to explain. You are with Monetary Metals, which is just monetary-metals.com, and Relationship Manager. And this is particularly interesting for Gold newsletter listeners or subscribers, because Dickson is a part of an organization which is trying to, there's some kind of trademarked tagline. It's like a dividend in gold, paid in gold, or something like this.
It's a yield in gold, paid in gold is what we have registered. Yeah.
Right. So this is the idea that they're proposing, that you can actually hold a portion of your portfolio in gold and then have that paid back, rather than in a dollar-denominated form in an actual proportion of gold. So this is still a relatively new idea or proposal. Why don't you just explain why you think this is particularly valuable or interesting? Why should people care about this?
Yeah, so I'll actually go back to Warren Buffett to answer that question. So Warren Buffett is a great investor. I don't think you can listen to anyone who would say the opposite. I don't think that doesn't. So Warren Buffett's a great investor, but that doesn't necessarily mean he gets everything right. And one asset class that he's kind of loved to hate on has been gold. His chief argument against gold as an asset class is that it's not productive. It doesn't produce a yield. I'd rather own the farmland that you can, plant something and have a productive output with that capital asset. So that's been his chief, criticism of gold as an asset class. And on that point, he's right. Now, there's a lot of reasons to own gold that don't have anything to do with whether or not it's a productive asset. We as a company are seeking to unlock the productivity of gold as an asset class. We're essentially seeking to prove Buffett wrong on that point. We want to enable owners and investors of gold the ability to own the gold, but also deploy the gold in a productive capacity to where they can actually receive an income on it, a yield on it, which is not paid in dollars, but paid in gold itself. If you believe gold to be a good monetary asset, which historically that has been true, and what's a property of money? Well, money ought to be deployed. Money ought to be able to be deployed productively and earn you a return. If that's true of money, then there's no reason why it shouldn't be true of gold.
Yeah, the three qualities of money are medium of exchange, unit of account, and store of value. So I guess you're leaning on the unit of account there, that you can measure your returns in terms of gold. And I love these ideas, of course. I want to see gold not being such a sterile asset, having new forms of ownership. And I hope to get Anthony Blanchard on the show in the next few weeks. I've been trying. He's an old friend, but he's super busy. But there are new frontiers for gold ownership, and Dickson is he's leading one of these. He's working with monetary-metals.com. Is there anywhere else that you are writing or where people can follow your work?
Yeah, I do have a personal blog. I hate to say it's not as updated as I'd like it to be. I've got about 20 articles I want to write, but none of them have published, so I just need to get my stuff out there. But that would be the only other place as of right now. I think down the road there may be some opportunities for me to write with Monetary Metals, what I'm doing there. But at this point, that's the only other place where.
What is that, just DicksonBuchanan.com?
It's DicksonBuchananJr.com, so JR.com is my personal blog.
Dickson, I really appreciate your time, and I hope you have a great time here in Guatemala. Thanks so much.
It's been a pleasure, Fergus. Thank you.